Welcome to this full audiobook of Mastering Forex Trading Sessions, how pros time their trades for big moves. In this guide, you'll discover the best times to trade Forex, which pairs to trade during each session, and how to time your trades like a professional. Whether you're trading from Africa, Asia, Europe, the Americas, or Australia, this is for you. Make sure to subscribe for more Forex audiobooks and strategies, and check the links in the description for free resources and the full book. Let's get started. Mastering Forex Trading Sessions, how pros time their trades for big moves. Before we start, please help the channel grow by subscribing to the channel. Let's get started. Introduction. The Forex market is open 24 hours a day, 5 days a week, but that doesn't mean every hour is a good time to trade. The key to becoming a successful trader lies not only in what you trade, but when you trade it. In this book, we'll break down the best times to trade different currency pairs, how market sessions work, and how to align your strategy with market volatility. Chapter 1. The most active trading hours. Time is a crucial factor in Forex trading. While the market is open 24 hours a day, 5 days a week, not all hours are created equal. Certain periods offer far greater liquidity, volatility, and opportunity, while others are slow with wide spreads and erratic price action that can trap unwary traders. Understanding the most active trading hours and aligning your trading strategy with these windows can make a significant difference to your success. The most active time in Forex trading occurs during the overlap of the London and New York sessions between approximately 1300 hours and 1700 hours Universal Time Coordinated. This is when two of the world's largest financial centers operate simultaneously, generating the highest trading volumes of the day. During this period, liquidity is deep, spreads are at their tightest, and price movements are more fluid. Traders benefit from cleaner breakouts, stronger trends, and rapid responses to news events. Many of the day's major economic releases, such as U.S. non-farm payrolls, inflation reports, and Federal Reserve announcements, are scheduled during this window. It is no coincidence that the most significant intraday trends and breakouts often occur during these hours. Currency pairs like Euro to US dollar, Pound sterling to US dollar to Japanese yen, and US dollar to Swiss franc typically see their most pronounced moves as both European and North American traders are active in the market. Before and after this golden window, the London session itself, from 7 to 1600 hours Universal Time Coordinated, provides rich trading conditions. As the largest Forex center in the world, London drives the bulk of daily turnover. The session opens as Asia winds down and traders in Europe begin placing their orders, reacting to overnight news, and positioning ahead of New York. The early part of the London session is particularly fertile ground for breakout strategies, as price frequently escapes the tight ranges that form during the quieter Asian hours. The session often features decisive moves driven by European economic reports, central bank commentary, and shifts in market sentiment. Pairs like Euro to US dollar, Pound sterling to US dollar, and Euro to Pound sterling tend to be the most active, with price action that favors both intraday trend followers and scalpers looking for quick momentum bursts. The Tokyo session, which runs from about 23 to 8 o'clock Universal Time Coordinated, opens the Forex trading day. While generally quieter than London or New York, it holds importance, particularly for traders focused on yen pairs or Asian markets. The Japanese yen sees increased activity during these hours, and movements in regional equity indices or commodity prices can influence related currency pairs like US dollar to Japanese yen, Euro to Japanese yen, and Australian dollar to Japanese yen. During the Tokyo session, price action often remains range-bound unless driven by economic releases, Bank of Japan statements, or unexpected news. For this reason, traders may favor range trading strategies, buying near support and selling near resistance unless volatility spikes. The session can also offer early positioning opportunities, as price patterns established during Asian trading often set the stage for breakouts during London hours. Successful Forex traders tailor their approach to the session at hand. During high-activity periods, such as the London-New York overlap, they may pursue breakouts and ride strong trends, capitalizing on the tight spreads and fast-moving price action. In quieter sessions like Tokyo, they may switch to range trading or stand aside, conserving capital for times when the market offers better conditions. The key is discipline. knowing when to engage and when to wait, and aligning trading strategies with the rhythm of the market. The best traders don't attempt to trade 24 hours a day. Instead, they build their plans around the sessions that match their style, their preferred currency pairs, and their capacity for focus and execution. Timing, as in many areas of life, is everything in Forex trading. Chapter 2. How to trade the Forex sessions effectively. Understanding the Forex market clock is only half the battle. The real edge comes when you know how to trade the sessions by adapting your strategy to the unique rhythm, liquidity, and volatility of each part of the trading day. In this chapter, we explore how to approach each session, what currency pairs to focus on, and what trading styles work best to align with the market's natural cycles. The Sydney session opens the trading week on Monday morning in Australia or Sunday evening in Europe and the United States. This session tends to be the quietest because it represents the smallest of the major financial hubs. During these hours, trading volumes are low, spreads are wider, and price action is often slow. The Sydney session favors range trading strategies. Since the market typically lacks strong directional movement, identifying key support and resistance levels allows traders to fade moves at the edges of the range. It is rarely the best time for scalping or aggressive breakout trades. However, if significant news has emerged over the weekend, such as geopolitical developments or natural disasters, the market may open with a gap, and traders can look for gap fill opportunities, though caution is advised. The character of this session is defined by low liquidity, limited follow-through on moves, and wider spreads on many currency pairs, especially those outside the Australian dollar and New Zealand dollar. The Tokyo session brings greater participation and volume, as Japan is a leading global economy. Movements in Asian equities, commodities, and economic data releases can drive price action during these hours, and the Japanese yen is often at the center of activity. The Tokyo session can be approached with a range breakout mindset, as prices may consolidate during the early hours and break from the range as Japanese markets fully engage. News events or central bank comments from Japan or Australia can generate sharp, sudden moves. Some traders also look for carry trade flows during this session, for example, buying higher-yielding currencies like the Australian or New Zealand dollar against the yen in periods of positive risk sentiment. The Tokyo session is characterized by moderate liquidity and the potential for sudden volatility, particularly if news hits or if the Bank of Japan takes action. Yen crosses often see their most significant moves during this period. The London session is the most active and liquid of all the sessions. This is when global banks, hedge funds, and corporations are active and the majority of daily Forex volume is transacted. Major economic reports from Europe and the United Kingdom often drive significant price moves during this time. This session is ideal for breakout and momentum strategies as price often breaks out of the Asian range during the early London hours, creating clean trends or reversals. Traders can look for breakouts from consolidation zones, continuation patterns, or reactions to economic data. Scalpers thrive during the London session thanks to tight spreads and fast-moving price action, while intraday swing traders can capture larger moves that develop during the session. The London session is known for high liquidity, strong trends, quick reactions to news releases, and often the cleanest price action of the trading day. The New York session, particularly its overlap with London, is the most volatile and active trading window of the day. This is when major U.S. economic reports are released, including market-moving data like non-farm payrolls, inflation figures, and Federal Reserve announcements. The London and New York overlap between 12 o'clock and 1600 hours Universal Time Coordinated provides rich opportunities for breakout and trend trading. This is the prime time for scalping, news trading, and riding momentum moves. Traders should focus on U.S. data releases and key market levels identified earlier in the day. As London closes, liquidity gradually thins, and the market often enters a period of consolidation or slower movement. At this stage, traders may consider scaling out of positions or tightening stops to protect profits. The New York session is marked by explosive volatility during the overlap, high liquidity early in the session, and a slower pace toward the close, with major moves often driven by U.S. economic data. Some of the best trading opportunities occur during the overlap of two major sessions, as these periods combine the liquidity and participation of two regions. The London and New York overlap is the most active time of the Forex day, ideal for breakout strategies, trend writing, and news trading. The Tokyo and London overlap is shorter but can still see transitional moves, especially in yen and euro pairs, as Europe reacts to Asia's trading flow and prepares for its own economic releases. Each session favors different trading approaches. The Sydney session is best approached with caution and range trading strategies, focusing on pairs like the Australian and New Zealand dollars. The Tokyo session rewards a reactive approach using range breakouts and news-driven trading, particularly in yen pairs. The London session suits aggressive trading styles with breakouts and trend-following strategies on euro, pound, and Swiss franc pairs. The New York session is fast-paced and ideal for breakout and news trading strategies, with US dollar and Canadian dollar pairs taking center stage. Traders should be mindful of common pitfalls such as overtrading during low liquidity hours, which often leads to frustration and unnecessary losses. Ignoring the news calendar is another mistake, as major data releases often dictate price direction and volatility. Applying one-size-fits-all strategies across sessions is equally dangerous. For instance, a scalping strategy that works during London's fast-paced environment might fail during Sydney's quiet hours. The disciplined trader focuses on high liquidity periods, adapts strategies to the market's rhythm, and always respects the clock. Timing, as in life, is everything in trading. Chapter 3. What pairs to trade and when? Choosing the right currency pairs at the right time is one of the most important decisions a Forex trader can make. Just as different sessions bring different levels of activity and volatility, different currency pairs respond more dynamically during certain trading hours. Trading the right pair at the right time helps you take advantage of higher liquidity, cleaner price action, and more reliable trends, while reducing the risk of wide spreads, false breakouts, and sluggish markets. In this chapter, we will explore when the major and popular cross-currency pairs offer the best trading opportunities and why timing matters when selecting which pairs to trade. Let's begin with the most liquid and widely traded pairs in the Forex market. Euro to US dollar, pound sterling to US dollar, and US dollar to Swiss franc. These pairs are deeply tied to the economies of Europe, the United Kingdom, Switzerland, and the United States, and as such, they are most active during the London and New York sessions. The London session sets the tone for these pairs as European banks, funds, and corporations transact large volumes to manage trade, investments, and speculative positions. As New York opens and overlaps with London, volatility and liquidity reach their peak, offering tight spreads and strong trends. Economic releases from the Eurozone, the UK, and the US, such as GDP, employment figures, inflation data, and central bank statements, often trigger decisive moves in these pairs during this overlap. For traders, this period offers the cleanest technical setups and the most reliable follow-through on breakouts and trend continuations. Scalpers, intraday traders, and swing traders alike benefit from the depth and activity of these hours when trading these major pairs. On the other hand, pairs such as US dollar to Japanese yen, Australian dollar to Japanese yen, and Australian dollar to US dollar come alive during the Tokyo and Sydney sessions. These pairs reflect the economies of Japan and Australia, both of which are active in their respective local market hours. The US dollar to Japanese yen pair, in particular, often sees its clearest directional moves during the Tokyo session, influenced by Japanese economic data, stock market performance, and occasional interventions or comments from the Bank of Japan. Similarly, the Australian dollar pairs, Australian dollar to Japanese yen and Australian dollar to US dollar, are more responsive during Sydney and early Tokyo hours, as traders react to Australian economic reports, commodity price shifts, and risk sentiment in Asia-Pacific markets. Liquidity for these pairs is generally better during these sessions, and spreads are tighter than at other times of day. Trading them during London or New York hours can sometimes result in quieter price action or choppier, less predictable moves unless specific news drives activity. When it comes to popular cross-currency pairs like Euro to Japanese yen and Pound sterling to Japanese yen, timing becomes even more critical. These pairs combine European currencies with the yen, and as a result, they tend to see their most pronounced movement during periods when the London session overlaps with the Tokyo session and when London overlaps with New York. During the London-Tokyo overlap, although brief, the market sees participation from both Asian and European traders, creating opportunities for directional moves as European sentiment interacts with price levels established during the Asian session. Later in the day, the London-New York overlap brings renewed volatility to these crosses, often extending trends or creating breakout opportunities as traders in the US respond to developments earlier in the day. Euro to Japanese yen and pound sterling to Japanese yen can be particularly rewarding during these overlaps because the combination of yen volatility with the force of European or US market participation generates strong, sustained moves. Timing your currency selection is about more than just matching sessions to pairs. It is about aligning your trading activity with periods when the market naturally supports your strategy. Trading euro to US dollar during Tokyo hours, for example, often leads to frustration as liquidity is thin, spreads widen, and price action lacks conviction. Likewise, trading US dollar to Japanese yen during the quiet tail end of the New York session might result in range-bound price action that offers little opportunity for momentum traders. By focusing on the right pairs at the right times, euro to US dollar, pound sterling to US dollar, and US dollar to Swiss franc during London and New York hours, US dollar to Japanese yen, Australian dollar to Japanese yen, and Australian dollar to US dollar during Tokyo and Sydney hours, and euro to Japanese yen and pound sterling to Japanese yen during session overlaps, traders can position themselves on the right side of the market's natural flow. This alignment helps reduce unnecessary losses, improve the reliability of technical signals, and make trading decisions more consistent with the rhythm of the global Forex market. Ultimately, successful traders are those who respect not only price levels and patterns but also the time dimension of the market. They understand that each currency pair has its own heartbeat, its own period of highest activity, and its own prime time when liquidity and volatility create the best conditions for trading. Mastering when to trade each pair is a crucial step toward building a sustainable trading edge. Chapter 4. Avoiding dead times. A key skill that separates professional Forex traders from amateurs is the ability to recognize when not to trade. While the Forex market is open 24 hours a day, 5 days a week, that does not mean opportunity exists at all times. In fact, much of the market's operating time is characterized by low liquidity, indecisive price action, and conditions that increase the risk of unnecessary losses. These periods, often called dead times, are when the market lacks the participation of major players, banks, funds, and institutions, and is instead dominated by smaller traders or algorithms simply maintaining existing positions. Entering trades during these times often leads to frustration as price action becomes erratic, technical levels lose reliability, and spreads widen. Recognizing and avoiding these dead times is a simple yet powerful way to enhance your trading discipline and protect your capital. The last few hours of the New York session, a dead zone for traders. The New York session is one of the most important and active periods in the Forex market, especially during its overlap with the London session. However, as the day progresses and the clock moves past 2000 hours Universal Time Coordinated, the character of the market changes dramatically. By this time, London has been closed for several hours and most major U.S. institutions, hedge funds, and professional traders have finished their business for the day. The large flows that create deep liquidity, tight spreads, and sustained trends during the overlap are no longer present. What remains is a market with significantly reduced participation where the majority of activity comes from smaller traders, position maintenance by algorithms, and a few lingering orders being cleaned up before the day ends. In this environment, liquidity becomes thin. Without major players to provide balance, the order book loses its depth, meaning that price can move sharply even on relatively small trades. For example, an order size that would barely register during the London-New York overlap might cause a noticeable price spike during these late hours simply because there are not enough counterorders to absorb it smoothly. As a result, price action often becomes erratic and unreliable, and technical levels lose their usual power. A support or resistance level that would typically hold firm during peak hours might be breached on a minor flow, only for price to reverse immediately once the small burst of activity subsides. Another hallmark of these late New York hours is widening spreads. Market makers and brokers recognize that with fewer participants, their risk increases. They have less confidence that they can offset trades smoothly. To compensate for this, they widen the bid-ask spread, making trading more expensive for the participant. For scalpers and short-term traders in particular, this change in trading cost can be deadly. A setup that looked profitable earlier in the day could now be neutralized simply by the spread itself, before a trade even has a chance to move. Price movements during this time also tend to lack conviction and follow-through. Any breakouts that occur often fizzle out quickly because they aren't backed by genuine institutional interest or fresh flows. This can create a frustrating experience for traders who see what looks like a clean technical setup, only to have it fail because the market simply doesn't have the participation needed to sustain it. It is not uncommon to see price drift sideways in a tight, choppy range, or to see small, sharp moves in one direction that quickly reverse as the market searches for liquidity. Some traders, particularly beginners, are tempted to squeeze in one last trade during these hours, driven by impatience, boredom, or the belief that more trading equals more opportunity. However, professionals know that this is usually a mistake. The last few hours of the New York session are best used for reviewing the day's performance, journaling trades, analyzing setups that worked or failed, and preparing plans for the next session. This period offers little genuine opportunity but presents outsized risks due to poor conditions. In summary, the final hours of the New York session represent a classic dead time in the Forex market. The lack of liquidity, the erratic price action, the widened spreads, and the absence of major players combine to create an environment where the balance of risk and reward is poor. By recognizing this and choosing to step back rather than force trades, you can protect your capital, maintain your discipline, and position yourself for success when the market's prime trading hours return. Friday afternoons, unpredictable markets as the week winds down. Friday afternoons represent one of the trickiest periods in the Forex trading week. At first glance, the market may appear to offer opportunity, price might be moving, and setups could look appealing. But beneath the surface, seasoned traders know that these hours often bring a special kind of unpredictability that can trap the unwary. This is because as the trading week nears its end, the market dynamic shifts dramatically and the flows driving price action are no longer about fresh positioning or new trends. Instead, much of the activity is driven by traders and institutions closing positions and adjusting portfolios to reduce exposure to the risks that come with holding trades over the weekend. One of the main reasons Friday afternoons are so unpredictable is the looming weekend gap risk. When the Forex market closes on Friday evening, it remains shut until it reopens late on Sunday. During this time, any number of events can occur. Political developments, natural disasters, unexpected economic announcements, or changes in geopolitical tensions, all of which can cause the market to gap significantly at the open. Large players such as banks, hedge funds, and corporates are acutely aware of this risk. As a result, they often choose to reduce or neutralize their exposure before the market closes for the weekend. This can lead to a flurry of position squaring, which creates price movements that aren't driven by fresh sentiment or market conviction, but simply by the desire to get flat. The impact of this behavior is twofold. First, liquidity begins to thin out as more and more large traders exit their positions and stop participating in the market. This makes price action more erratic as there are fewer orders to absorb any remaining flows. Even modest-sized trades can cause exaggerated movements, creating the illusion of breakouts or new trends that quickly lose steam. Second, price movements lack follow-through because they're not the result of new information or genuine market sentiment, but of end-of-week housekeeping. A breakout above a key level late on a Friday is far less reliable than one that occurs earlier in the week when the market is building new positions. Friday afternoons are also complicated by the psychological and practical pressures facing traders. Some feel the urge to make up for the week in these final hours, leading to impatient or forced trades that don't meet their usual standards. Others may hold onto positions too long, hoping for one last burst of profit only to be caught out by a sudden reversal or choppy price action. Furthermore, brokers and market makers are aware that liquidity is dropping, so spreads may widen, adding hidden costs to late-week trades. In short, Friday afternoons are a classic example of a dead or dangerous time in the Forex market. Price action becomes harder to read, technical signals lose reliability, and the risks of surprise moves and gap exposure increase. Professional traders know that this is a time to step back to secure the profits of the week, review performance, and plan for the week ahead rather than chase uncertain setups. By respecting the unique challenges of Friday afternoons, you protect your capital, avoid unnecessary stress, and position yourself to start the next trading week fresh and focused. Holidays. When major centers go quiet, markets thin out. Public holidays in key financial centers like the United States, United Kingdom, and Japan create some of the most challenging trading environments for Forex participants. While the Forex market technically remains open during these holidays because the market operates globally, the absence of these major players means that the market loses a huge portion of its usual liquidity. These countries represent some of the largest sources of volume in the currency markets. When they are offline, either due to national holidays or bank closures, the entire market feels the effect. When liquidity is thin, price movements become far less reliable. There are simply fewer large orders in the market to provide balance and depth. This means that even small flows, such as orders from smaller institutions, retail traders, or automated systems, can push the market in exaggerated ways. What would normally be minor fluctuations can turn into sharp spikes or drops because there is little resistance in the order book to absorb those trades. As a result, price action during holidays is often erratic and misleading. Technical levels that would typically act as strong support or resistance may be breached easily, only for price to snap back once normal participation resumes. Traders might see what appears to be a breakout or trend forming, but without true institutional backing, these moves frequently fail to follow through. Another issue during holiday periods is the widening of spreads. With lower liquidity comes greater risk for market makers and brokers as it becomes harder to match buyers and sellers efficiently. To protect themselves from unexpected volatility, brokers often increase the bid-ask spread, making trading more expensive. For short-term traders, particularly scalpers or those relying on tight stops, these wider spreads can instantly turn a profitable setup into a losing trade before price even begins to move in the intended direction. It's also important to understand that the Forex market behaves differently depending on which country is observing the holiday. When Japan is offline, Asian session liquidity dries up and pairs like US dollar to Japanese yen or Australian dollar to Japanese yen may hardly move at all, or they may behave unpredictably due to the absence of yen flows. When the UK is closed, the London session loses its driving force. And because London is responsible for the largest share of daily Forex volume, this creates extremely subdued or choppy price action across Euro, GBP, and CHF pairs. When the US is on holiday, the powerful liquidity and volatility that the New York session typically contributes are missing, making the overlap period with London far less active and dynamic than usual. Finally, one of the hidden dangers of holiday trading is that traders may underestimate the risks because the market is technically open. A trader might think the market's open, so opportunity must still exist. But without the participation of major institutions, those opportunities are often illusions, traps that catch traders with false breakouts, whipsaws, or sudden reversals driven by minor flows. This environment can also embolden large players who are active to push price around more easily, knowing there is less resistance in the market. Smart traders check holiday calendars in advance and either stand aside or reduce their trading activity significantly during these periods. By respecting these conditions, traders can avoid the frustration and unnecessary losses that so often come from attempting to trade in a market that simply isn't offering genuine opportunity. In Forex, knowing when to stay out of the market is as valuable as knowing when to get in. Chapter 5. Aligning session times with strategy. Success in Forex trading is not just about having a sound strategy. It's about applying that strategy at the right time. Each trading style depends on specific market conditions to work effectively. Those conditions, whether high liquidity, clear trends, or sharp bursts of volatility, are not constant throughout the 24-hour Forex cycle. They vary depending on the trading session, the participants active at that time, and the market's fundamental drivers. In this chapter, we will explore how scalpers, swing traders, and news traders can align their strategies with the session times that best support their approach so they can maximize opportunity while minimizing frustration and risk. Scalpers, the need for high liquidity and the power of the London/New York overlap. Scalping is one of the most demanding trading styles in Forex. It involves entering and exiting trades very quickly, sometimes within seconds, rarely holding a position for more than a few minutes. The goal is to capture small price movements, often just a few pips, and repeat this process many times throughout a session. Because the targets are small, the conditions in which scalpers operate must be precise. Above all else, scalping depends on high liquidity. Without it, the costs of trading through wider spreads and slippage can quickly eat up any potential profits. Liquidity ensures that the bid-ask spread stays tight, order execution is fast and clean, and price movements are smooth rather than choppy or erratic. The best environment for scalpers is during the London/New York overlap, which occurs between approximately 12 o'clock and 1600 hours Universal Time Coordinated. During these hours, two of the world's largest financial centers are operating simultaneously. This overlap generates the deepest liquidity of the entire trading day. Banks, funds, corporations, and large institutional traders are all active, and their transactions create a steady flow of orders that scalpers can exploit. Because so many players are involved, the market offers frequent short-term movements with enough follow-through to make scalping viable. Spreads on major pairs like euro to US dollar and pound sterling to US dollar are at their narrowest, which is critical when every pip matters. In contrast, attempting to scalp outside of this overlap can be frustrating and risky. When liquidity thins out during the Asian session or late US hours, spreads widen, price movements slow down, and what little action remains can become erratic, driven by small players or algorithms rather than solid institutional flows. In such conditions, scalpers may find their stops triggered by random noise or their gains eaten up by costs they cannot control. To succeed as a scalper, a trader must not only master rapid decision-making and precise execution but also know when the market offers the right environment. This is why aligning a scalping strategy with the London/New York overlap is critical. It ensures that each trade is placed in conditions where the balance between risk and reward favors the trader, with tight spreads, fast fills, and the kind of steady micro-movements that make scalping profitable. Swing traders capturing breakouts in the early London or Tokyo sessions. Swing trading is a style focused on capturing larger price movements that unfold over several hours, days, or even weeks. Unlike scalpers who aim for small, quick profits, swing traders look to enter the market at the start of a significant move and hold their positions long enough to ride a meaningful portion of the trend. This approach requires clean, directional price action, the kind that emerges when the market breaks out of consolidation or begins trending in response to fresh momentum. For swing traders, the key is to identify moments when the market transitions from balance to imbalance, when supply and demand dynamics shift in a way that fuels sustained price moves. The best opportunities for swing traders often appear during the early London session and the Tokyo session. The early hours of London, starting around 7 o'clock Universal Time Coordinated, mark the time when European traders enter the market in force. This injection of liquidity and fresh sentiment frequently causes the market to break out of the tight ranges that formed during the quieter Asian hours. Swing traders can capitalize on these breakouts by identifying key levels that were respected overnight and entering trades as price bursts beyond them. Since the London session sets the tone for the day's direction in many major pairs, especially euro to US dollar, pound sterling to US dollar, and euro to pound sterling. Early London breakouts are often the start of larger moves that can be held over multiple hours or even across sessions. Similarly, the Tokyo session provides valuable opportunities for swing traders, particularly those focused on yen-related pairs like US dollar to Japanese yen, euro to Japanese yen, and Australian dollar to Japanese yen. When Tokyo opens, the market reacts to overnight news, regional equity market movements, and Japanese economic data. These factors can drive clean breakouts or establish new intraday trends. Swing traders operating during this session look for the point where price breaks out of pre-session consolidation, entering trades that aim to ride the momentum as Tokyo liquidity builds. A critical advantage of trading these sessions is that breakouts during these times tend to have follow-through. Unlike during dead periods, when breakouts are often false or short-lived, early London and Tokyo breakouts are supported by institutional flows, large order books, and the participation of major players. This means that once a level is broken, there's usually enough interest to sustain the move, providing swing traders with the conditions they need to set targets and manage risk effectively. In short, swing traders thrive by aligning their strategies with periods when the market is most likely to break out of range and establish trend direction. The early London and Tokyo sessions offer the perfect environment for this style as they combine fresh liquidity, news-driven sentiment, and the participation of large players, all essential ingredients for sustained price movement. News traders, timing trades around key economic events. News trading is a style that focuses on capitalizing on the sharp price movements that occur immediately after important economic data releases, central bank announcements, and major political events. Unlike scalpers or swing traders who primarily rely on technical setups and market structure, news traders base their decisions on fresh information hitting the market, information that forces traders, institutions, and investors to quickly reprice currency values. This approach demands precision in both timing and execution because the window of opportunity is often narrow and the volatility is intense. The most fertile ground for news traders lies during the London and New York sessions, especially during their overlap. This is because most of the world's critical economic data is released during these hours when liquidity is deep and market participation is at its peak. For example, the U.S. non-farm payrolls (NFP) report, one of the most anticipated releases on the Forex calendar, is issued during the New York session, typically on the first Friday of each month. Similarly, policy announcements and rate decisions from the Federal Open Market Committee (FOMC), the European Central Bank (ECB), and the Bank of England (BOE) are scheduled during these core sessions so that they coincide with maximum market attention. When such news breaks, price can move dramatically within seconds as traders and algorithms rush to adjust positions in light of the new information. For news traders, these moments can present highly profitable opportunities, but they also carry significant risk. Liquidity, while deep overall, can dry up temporarily in the immediate aftermath of a major release, as spreads widen and slippage becomes a concern. This is why news traders must not only understand the timing of key events but also prepare with clear entry plans, predefined risk limits, and disciplined execution. They must know when to strike and when to stand aside. Not every news release generates tradable volatility, and not every spike offers a clean setup. Importantly, news traders do best during the London/New York overlap because it provides both the liquidity needed to enter and exit efficiently and the event-driven volatility required for large, fast-moving price swings. Attempting to trade news outside of these major sessions, for instance during the Asian session, can be disappointing as even significant headlines may not generate enough activity to create meaningful opportunities. In summary, news trading is all about timing, knowing what to trade, when to trade, and how to trade during the market's most explosive moments. The London and New York sessions offer the perfect stage for this style, combining high-impact events with the liquidity needed to trade them effectively. Chapter 6. Time Zones and Your Trading Plan. One of the most important yet often overlooked aspects of Forex trading is how your local time zone aligns with the global market's rhythm. The Forex market operates 24 hours a day from Monday to Friday, creating the illusion that opportunity is always available. But in reality, certain hours offer far better conditions than others, and trying to force trades at the wrong time often leads to poor results. Many traders fall into the trap of chasing the so-called hot hours, for example, staying up late or waking at odd hours to trade during the London/New York overlap. While this period does offer high liquidity and clean price action, the physical and mental cost of trading outside your natural rhythm is often too high. Fatigue, reduced concentration, and emotional decision-making set in, leading to mistakes that could easily have been avoided. The key to long-term success is not in trading the busiest sessions at any cost, but in building a plan that aligns with your time zone, lifestyle, and energy levels. Pick pairs that move well during your daytime. One of the most effective ways to align your trading plan with your local time zone is to focus on currency pairs that naturally experience strong movement during your daytime hours. The Forex market is active 24 hours a day, but not every currency pair is liquid or volatile at all times. Each trading session, whether it's Sydney, Tokyo, London, or New York, has certain pairs that see higher volume and cleaner price action, because that's when the economies those currencies represent are most active. By selecting pairs that are naturally moving while you are alert and available, you can trade in better conditions, avoid unnecessary fatigue, and stay sharp when it counts. For example, if you are based in Asia or Australia, your daytime hours align with the Tokyo and Sydney sessions. During these periods, pairs like US dollar to Japanese yen, Australian dollar to Japanese yen, and Australian dollar to US dollar are most active. These pairs react to regional economic data, equity market movements in Asia, and local geopolitical developments. Trading these pairs during your daytime means you are participating when institutional flows from Asian banks, funds, and corporations are at their peak, creating liquidity and clean price action. If you are based in Europe or Africa, your daytime aligns naturally with the London session, one of the most liquid and active periods of the Forex day. Pairs like Euro to US dollar, Pound sterling to US dollar, Euro to Pound sterling, and US dollar to Swiss franc tend to see the most movement during these hours, driven by European data releases, policy decisions, and market sentiment from the region's major financial centers. By focusing on these pairs, you benefit from tight spreads, solid follow-through on breakouts, and the kind of momentum that makes technical setups more reliable. For traders in North or South America, the New York session offers strong movement in USD pairs, like US dollar to Canadian dollar, US dollar to Japanese yen, and Pound sterling to US dollar, and commodity-related currencies as well as major crosses involving the US dollar. This is also when many key US economic data releases hit the market, creating volatility and opportunity. Since these events occur during normal business hours in the Americas, traders can participate in them without the physical and mental toll of trading overnight. By picking pairs that move well during your daytime, you position yourself to trade with focus, energy, and discipline, making the most of the hours when you're naturally alert. You also avoid the trap of staying up late or waking at odd hours just to chase opportunity in other sessions, which often leads to fatigue, poor decisions, and inconsistent results. In short, trading pairs that are active during your natural day helps you work with the market and with your own rhythm, a key to long-term success. Use pending orders if you can't be at the screen. One of the greatest advantages of modern Forex trading platforms is the ability to place pending orders, instructions that tell the system to enter or exit trades at predefined price levels, even if you are not actively monitoring the charts. This tool is especially valuable for traders who operate in time zones where key market moves may occur during inconvenient hours. Instead of staying awake at night or disrupting your daily routine to catch a breakout or retest, you can plan your trades in advance and let the market come to you. This approach not only frees you from the screen but also helps you trade with greater precision, discipline, and peace of mind. There are several types of pending orders, each suited to different trading scenarios. Buy stop and sell stop orders are used to enter the market when price breaks beyond a certain level, ideal for trading breakouts or momentum-driven moves. For example, if you've identified a key resistance level and believe that price will rally strongly if that level is breached, you can place a buy stop just above it. If the breakout happens while you're asleep or at work, your trade is triggered automatically without the need for you to be present. Similarly, buy limit and sell limit orders allow you to enter the market on retracements, for example, buying at a lower price in an uptrend or selling at a higher price in a downtrend. This is useful for traders who want to catch pullbacks without staring at the screen for hours waiting for the perfect entry. Pending orders are not only about convenience, they are also a powerful tool for removing emotion from your trading. When you place a pending order, you are making a plan and committing to it in advance. You define your entry, stop loss, and take profit levels calmly based on analysis rather than the heat of the moment. This helps you avoid impulsive decisions that can arise when watching price tick up and down live, and it keeps your risk management intact. Furthermore, pending orders can help protect you from missing opportunities. Instead of watching price hit your level and reverse while you were away, your order executes automatically, ensuring you don't miss planned trades due to life's other demands. In short, using pending orders is a smart, strategic way to stay engaged with the market without sacrificing your well-being or lifestyle. It allows you to maintain discipline, capture opportunities, and reduce the stress that comes from trying to trade at all hours. By incorporating pending orders into your trading plan, you can trade smarter, not harder, and build a more sustainable path to long-term success. Chapter 7. The Danger of Overtrading. One of the most common traps that Forex traders fall into, especially beginners, is overtrading. The allure of the market's constant movement, the excitement of watching price action tick up and down, and the desire to make profits quickly can tempt even disciplined traders to take too many trades. It often starts innocently. A setup looked good but didn't work out, so the trader tries again. Maybe they see a small move and want to catch the next few pips. Maybe boredom sets in during quiet periods and they start trading just to stay active. But what begins as an effort to stay engaged quickly spirals into a dangerous cycle where trades are placed without clear reasons, strategies are abandoned, and losses start piling up. Even during the best trading times, such as the London/New York overlap, overtrading can destroy profitability. The fact that liquidity is high and price action is clean does not mean every movement is worth trading. The reality is that the best traders know how to wait. They sit patiently, sometimes for hours or even days, for the high-probability setups that align perfectly with their plan. They don't force trades just because the market is active. Instead, they understand that their edge comes from discipline, timing, and precision, not from trying to catch every move. Overtrading leads to multiple dangers. First, it erodes your mental capital, the focus, clarity, and emotional control you need to trade effectively. The more trades you take without purpose, the more stress and frustration build up, and the harder it becomes to make sound decisions. Second, it increases trading costs. Every trade carries a spread or commission, and frequent, unnecessary trades add up, eating into your bottom line. Third, overtrading often causes traders to stray from their risk management rules. When chasing losses or reacting emotionally, position sizes may creep up, stops may be widened, and discipline begins to crumble. The solution is simple in concept but challenging in practice. Patience equals profit. The most consistently successful traders are not the ones who trade the most, but the ones who trade the best. They focus on quality over quantity, waiting for the market to present the kind of setup that matches their plan exactly. They understand that sometimes the best trade is no trade at all, that protecting capital during subpar conditions is just as important as making money when opportunity is high. By mastering patience, you reduce stress, protect your account, and position yourself to capture the right trades at the right times. In short, the Forex market offers endless opportunities, but not all of them are worth pursuing. Overtrading is the enemy of consistent success. The disciplined trader who waits for high-probability setups during the best windows and acts only when conditions are ideal is the one who endures and thrives in the long run. Conclusion. Mastering the when and what of Forex trading. Throughout this book, we've explored one of the most overlooked keys to success in Forex trading: timing. Knowing when to trade, aligning your strategy with the right session, avoiding dead times, and respecting your personal time zone can make the difference between frustration and consistent progress. Equally important is knowing what to trade during those times, choosing currency pairs that are active and liquid, and applying strategies that fit the conditions of the session. By combining this knowledge of market timing with solid risk management, you create a powerful foundation for your trading journey. No longer are you chasing the market at random hours or forcing trades when conditions are poor. Instead, you are approaching the market with clarity, discipline, and purpose. You focus your energy on the sessions and setups that offer genuine opportunity. And you step aside when the balance of risk and reward is no longer in your favor. In the end, successful trading is not about working harder or trading more often. It's about working smarter, aligning your plan with the market's natural rhythm, and respecting the conditions that give your strategy the best chance to succeed. When you master the when and what of Forex trading, you move closer to your goal, trading with confidence, precision, and consistency. Thank you for listening to Mastering Forex Trading Sessions, how pros time their trades for big moves. I hope this audiobook helps you trade smarter, time your sessions better, and achieve consistent results. No matter where you are in the world, you can trade at the right time and with the right strategy. Don't forget to subscribe, like this video, and share it with other traders who can benefit. Check the description below for links to the book, free trading resources, and more Forex content. Trade smart and see you in the next video.